Hey everyone, this week's episode is brought to you by Casa, one of our portfolio companies. Let's be honest, how confident are you feeling right now about the security of your Bitcoin? Every quarter we hear a new horror story, exchange hacks, exit scams, a friend losing their PIN, or someone passing away and having their family come up empty-handed. The best way to keep your Bitcoin safe is to hold it for yourself, and Casa is the easiest and the safest place to do that. They have one of the most well-respected teams in the industry, amazing design, and 24/7 support that'll help you every step of the way. Premium memberships also include the Bitcoin Inheritance Planning product, white glove support for large Bitcoin purchases, and services that were previously only available to ultra high net worth customers. If you're ready for a security upgrade, you can get started with a membership for as little as $10 a month. And as a special offer, use the coupon code CASTLE to get 10% off. Head over to keys.casa to get peace of mind that your Bitcoin is safe. This week's episode is with Tim Kelly, the founder and CEO of BitOoda, a digital asset financial services platform that specializes in structured products, risk management, and market analysis. Tim and BitOoda are at the cutting edge of financial derivative products based on Bitcoin hashrate. These products help mining companies hedge their exposure and locked in fixed rates for their hashrate. I wanted to have Tim on the podcast because he has a rich history at the intersection of asset classes as they are maturing, and I think that Bitcoin is certainly in this category. He is a several-time successful entrepreneur who began his career as a pit trader, and he later started two businesses in the commodity and energy trading space. I learned a lot in this one. I think it's a really interesting field, and I hope you enjoy it. So without further ado, here's our conversation with Tim Kelly of BitOoda.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $trillion, and all of a sudden people start to worry. So out of this worry, we have something called the Bitcoin.
Tim, thanks so much for joining the podcast today.
Oh, great. Thank you for having me, Matt.
You're calling in from Falmouth, Massachusetts, so I'm a little bit jealous that you're down the Cape so early, but I guess you've been down there for a while, extended quarantine. How's your lockdown going?
Oh, it's fine. We've been here for 2 months, and we were in Jersey City, and we shut that office down on March 4th. So we're in a much better position, I think, than unfortunately most people in New York has just really been impacted so severely, unfortunately.
Well, I'm really excited to have you on the podcast today. I think your career history and the asset classes that you've been involved with really lend themselves well to kind of a discussion around crypto, particularly around some of the derivative instruments that are coming onto the scene. And you're someone that's seen asset classes institutionalize over time. So maybe before we dive into the crypto stuff, could you just give the listeners your introduction, a little bit about your career story and how you came to start BitOoda?
So let me just a little background. So basically 25 years in derivatives, both trading and brokering. I started my career in Chicago in the 30-year bond option pit, and this is back in 96. Things were very different. And it's kind of a funny story. I was working for a very large group, trading for a very large group in the pit. And one night we all went out to the riverboats of Chicago, and I made a ton of money playing blackjack. Just got lucky. And so I told my bosses I'm going to go off and back myself and started trading my own money. And they were fine with it. I mean, it's totally different times back then. So they would totally respect the decision. And then I really didn't know anything about trading. And I literally blew out 3 weeks later. The Asian contagion hit. And I was the first offer on the first straddle that Soros came in, about 10,000 straddles. And that was sent to me. So, yeah, it was pretty amazing. I mean, I think I had the shortest executive career since that Pope who was poisoned. But actually, that's when the firm, the FCM backing me, actually kept me in the pit. I don't really tell you how much I lost, but it was probably the best thing that ever happened to me. And then I really got mindful about risk management. And I think that event, while incredibly painful, I really became an ardent believer in risk management. And we really refer to it as really just in case and not just in time. And that experience, I think, is very helpful as we talk to people about risk management. It's really hard to talk about risk management unless you've actually been through it. I did that. I think they say in poker, like, if you don't know the fool at the table, this is probably you. That was me. But yeah, I blew out in front of 800 fellow people in the pit. And I can tell you, loneliness is a crowded room. It was a devastating day. So I made it back. And then after about 5 years in the pit, a number of my friends and buddies and colleagues that traded in the pit were being recruited. This is the height of the Enron cycle. And a number of guys that I knew were getting recruited to trade for energy merchants. I didn't even know what an energy merchant was at the time, but this is when Enron was flying and all the other energy merchants were. So I actually left trading and became a broker because these are guys I knew really well. And there were three of the largest energy, natural gas derivative traders in the market. So I got a job. They got me a job in New York. I went to work for them, covered them, and built a pretty healthy business. And I got to work at a big interdealer broker at the time. And then 6 months after that, Enron blows up. I got a really great understanding of how quickly a situation can deteriorate and how important credit is. And it was a credit crisis. We lived it. It really seized the markets for a year. And another invaluable lesson of how important credit is. We never want to swap price risk for credit risk. And I really learned it. From Enron, it was incredible. That entire market seized up overnight. So then I went on, just two highlights of just my background. I don't want to spend too much time, but I was very fortunate to start two firms on my own. One, I sold to ICE, the Intercontinental Exchange, in 2007. And that was a wonderful experience, great people. And it was also fantastic experience working at a regulated exchange. And it really, we were tasked with trying to migrate business from the CME to ICE. ICE's position was we had better technology, but nobody's using it. We built it and nobody's coming. And our responsibility was try to move business over. So we worked across many different teams at ICE, but gained a real, very good understanding of how the power of adoption and gaining critical mass and network effect and all of that really worked. And just for perspective and context, when we joined ICE, I think seven lots of commodity options, derivatives had traded. And then by the time I left 4 years later, it was like 400,000 to 500,000. So it was not just my teams. It was a number of internal groups at ICE that deserve a lot of credit for that. But I was really thrilled with my experience at ICE. And just working at a regulated exchange, how important it is to have a regulated exchange in a very strong, robust jurisdiction. So that was ICE. And then I left after 4 years. I started another firm, Forward Insight Commodities, which was really execution and research focused. And I really felt that research was the key to kind of distinguishing ourselves from our competitors. And ultimately sold that firm to FC Stone, which was a large FCM, futures commission merchant. For those who I use a lot of abbreviations, so please slow me down. But the FC Stone experience was wonderful because then I really got more insight into how powerful it is to have a credit intermediary and how the system, when it does, not if, when shocks happen, when 100-year events happen every other year, so you see how the system can handle those shocks. And then I thought I retired in 2016, and I've been following Bitcoin since 2011 because one of our clients, one of our largest market makers, had been buying a ton of Bitcoin early on and mining and everything, and very sizable positions. And they're telling me about it and just say, you got to take X and buy a bunch of this, and this is going to be the future. And of course, I never pulled the trigger. Then Mt. Gox happened, and I said, oh, wow, I got scared. And then, so basically the first time I really started paying attention to Bitcoin and blockchain and was in 2016 after I retired. I was living in Nantucket, and I got invited to the Boston FinTech Sandbox. So I literally left the beach. Just kind of funny. I left the beach. I went to the Sandbox in Boston, and I listened to this project that was this blockchain project. Brilliant MIT, computer science, PhDs, et cetera. And it was fascinating to listen to them. It was a wonderful 2-hour conversation. It was wide-ranging. It was really fascinating. And I learned a ton. And then I was walking out. They were trying to disrupt the crude market and leveraging blockchain and revisiting how crude trades physically and financially. I asked them what grade or what index you're going to start with. WTI, Brent, you're going to be in Europe, you're going to be domestic here in the US. And they looked at me and said, what are you talking about? What is that? What do you mean? And I said, well, you don't know what WTI and Brent are. And I didn't mean to in any way these guys were absolutely brilliant, but they had no domain expertise. And I left that meeting saying, wow, there is an opportunity here. And I went back to my house in Nantucket and spent the next 6 months just writing a business plan, doing as much research as I could, trying to understand the market, where it was, and if there was an opportunity. And I really felt that after about 6 months, I had a business plan put together. I reached out to anybody I respected in so many different fields and kind of bounced ideas. It was a really collaborative effort to put that business plan together. And then there was one exchange that doesn't need to be named, but in June of 17, there was a crash on ETH. There was a $12 million, I believe, notional order. Somebody hit the market and drove ETH down from 300 to a penny, and then right back to a penny, back to $300. And I was kind of shocked by that there were no circuit breakers, et cetera. And then the exchange's response was even more disturbing, but also it convinced me that there's a real opportunity and I got to go for it. And it's clear that this exchange didn't understand that with cascading effects and what happens in a market sell-off when you can go from $300 to a penny and then right back, and then say that all these, our matching engine worked, et cetera. So that's when I went for it. And I just said, I'm going to start a company. I moved back to New York, got myself a hotel room for about a year, and started just dive right in. And it literally has been nonstop since. And that's when I formed BitOoda. And now we're up to 8 people. And that's kind of how I really started the firm. And it was shocking how little I knew, but I just said, I've got to get in here. If I'm going to do this, I just got to jump in and just go for it.
That's great. I want to get into kind of what BitOoda does and what you're doing now, what your broader vision is. But a couple of the things that you said really piqued my interest. So obviously, you're in the market infrastructure space. You saw this asset class and you saw that there needed to be a tremendous amount of infrastructure that didn't exist to build around it. One of the things that we kind of don't talk about a lot necessarily is just that infrastructure kind of needs an investment thesis sitting on top of it around why you'd want to hold some of these assets. And it's pretty clear with Bitcoin that this is a non-sovereign store of value, or at least an option bet on the emergence of one. But there are kind of a broad range of other crypto assets that are trying to do different things. I'm curious if you have an orientation towards which parts of this industry are the most exciting, just from an asset perspective around why you'd want to hold some of these things. And maybe as a follow-up to that, how do you explain what this is to someone that might be familiar with capital markets, but is less familiar with the intricacies of a Bitcoin versus an ETH versus any number of other coins?
My experience is somewhat narrow but deep. Just because of time and resources, we have just really dived deeply into Bitcoin, and really our focus has been the financialization of mining. That's really our focus. That doesn't mean I just haven't put the time into the other projects. I'm actually scheduled later in the week to really start working on a research piece for DeFi. One of our clients, super sharp guy, one of the big funds on the West Coast, really wants to work on something in DeFi. And I said, I'd love to get educated. I've just got to find the time. So we're going to try to co-author a piece on DeFi, but I've got to get myself up to speed. But really our focus has been Bitcoin, and really, as my team is largely commodity in orientation, and also we really come from a nonlinear or derivative background. So we gravitated to miners, just as we would think of miners, or we really like to think of miners. We think that doesn't really capture who they are. We really think of them as data centers, and they're very akin to, you refer just like an oil producer. And a lot of how we cover and we approach markets and products is just like we would do in the commodity markets. One, we identify who the natural long is, who the natural short is, and then we try to identify the risks and then mitigate those risks. And I think that's really what BitOoda is known for, is really the risk management, if you will, regarding miners. And we're really proud about the work we've done there, whether it's our hash contract or difficulty swaps or some of the other swaps and products that we're looking to build. But really that's our focus.
And certainly you could go deep on Bitcoin. There's so much infrastructure that's just not built out. So that makes a ton of sense. So why don't you set the stage for us a little bit and just tell us about BitOoda? What was your vision when you started the firm? What's the firm doing now? What's the broader vision around what you're building?
Certainly we made some pivots, but I think most importantly, we looked at the space, and the thesis really has to, we are an agency firm. We place a tremendous amount of emphasis upon being regulated, being compliant. We're an institutional firm. We really don't have any expertise in cover retail. So we're regulated by both the CFTC and the SEC. We're hoping to get our BIT license. But really that was day one, we started applying, sending in our applications to the CFTC and the SEC. So that's number one. I mean, I think that's critical for anyone that is looking at BitOoda. We're not that vocal because we are an institutional firm. We're not good at it. We're not someone that focuses on retail. And then really too, it's nonlinear derivative products, whether it's trade like I'm working right now for on CME Clearport or hash or difficulty swaps or really anything nonlinear on exchange, off exchange. That's what we do. That's really our expertise.
When you look at crypto and you look at some of the product potential here, you look at a lot of the products, frankly, that just don't really exist yet at scale. Does it remind you of any other asset classes? I mean, you've been around sort of the emergence of a bunch of different assets here as they have matured. Does crypto look like anything else to you?
In some ways, yes, it certainly does. One, I think it's an unrepeatable opportunity, literally unrepeatable. And I think it certainly reminds me of traditional markets that there's hedgers, there's speculators, there's structures in the middle, originators. And it's really a unique space is that for our hash contract, for instance, this is kind of unique, maybe because I've come from mature markets, but in these immature nascent markets, there's a lot of, really, we're so fortunate to have so much collaboration when we developed the hash contract. Half the, we call it a dozen firms. Half were miners, and then the other half were more speculative alpha funds. This was not a BitOoda effort by ourselves. This was probably a dozen different firms. So it's really cool that I've never seen another asset class, really firms coming together and trying to collaborate. So that's awesome. And I love to see that. I'm so passionate about the ecosystem. I don't like that tribal type of narrative that happens sometimes. The one thing that I will say that is surprising, I guess unique, is that since we're a regulated firm and compliant, especially coming from ICE and working for a regulated derivative exchange, it concerns me that there are unregulated derivative exchanges operating in wherever they're domiciled, no FCMs, no shock absorbers, run by trading firms. It's not something that I'm familiar with and not something that really I would ever want any of our clients trading on a platform like that. So that's a little surprising to me, is that some people have this almost disregard for regulations. And when you're dealing in derivatives in the US, you have, if you're facing clients, and there's a lot of firms that there might be a market maker and then they have a sales force. That sales force has got to be regulated. They've got to be licensed. And all their chats have to be recorded on compliant chats. We use ICE chats. I have a lot of former colleagues at ICE, but it's an incredibly slick and great way to communicate. Yeah, I'm trying to do a trade right in the middle of this interview, so sorry. But I don't even think that firms understand their obligations. I mean, one thing, not only are we, two key points is one, we're regulated by the CFTC/NFA, and two, we've been successfully audited. I'm very proud of my team. It took 5 months, but we went through an NFA audit, and we've already been audited. So it's very hard to take a path of, in the US or G7 for that matter, to take a path of not being regulated and then trying to safe harbor, et cetera. It's just not how the regulators work. So I think that is one very strong and robust strategic advantage that BitOoda has, is that we're regulated. And we love to hear the news that Paul Tudor Jones coming in the market. I mean, that's really our DNA. That's who we cover. That's who we know. And we hope that we're hopefully one of the few firms that can service clients properly, that we can onboard these funds because we are licensed and regulated.
I think the Tudor Jones news is just really important for a number of reasons. One is that you just haven't seen historically a lot of funds putting money to work in this space. It's one thing to do it on a personal account, but to do it as a fiduciary for your limited partners is a whole different story. So I think it's a huge point. You bring up a really interesting point around kind of the offshore exchanges, and Nick and I have called these the altcoin casinos, for lack of a better word. And it's interesting because they're not really trying to service an institutional client base. It would be almost impossible to imagine a fund like Renaissance or Paul Tudor Jones's fund coming in and accessing liquidity on those venues. But the reality is that this is still a very retail-driven market. So it seems like they've been very effective at attracting that retail flow, and certainly there are trading firms that can participate there. Do you think that it's a sustainable equilibrium in the market here to have that much liquidity kind of on these venues, or do you think that we'll find a way to get more of that onshore in the future?
Absolutely not. It's binary. Leaders are going to become bleeders. That's what we say. I don't know how you could possibly run an unregulated derivative exchange. It doesn't matter if you're based in Antigua or Panama or wherever location. If your operations in Hong Kong, the regulators are going to come down. When we get through this in the SEC, you're seeing some of the SEC take significant action I think the regulators, there's no way you can be running. I mean, you have to be mindful of the context where we're 10 years post 2008, 2009. I lived through Dodd-Frank. I can tell you that anyone operating an unregulated derivative exchange, I don't care where they are, it's a binary risk. I would be buying puts if I could on those operations. I don't even want to name them because I don't even want to do the justice, but I don't see how that continues. And we certainly are very mindful. You have to focus on return of capital sometimes than return on capital. And when these exchanges, and they will, when they have an event, they are going under and they're going to take all the clients' funds with them. And that's it. I think it's absolutely terrible for the ecosystem. 100-to-1 leverage, that's complete nonsense. And I agree. I really enjoy the bat that you and Nick put out. And I think we're very aligned. But it's great to see the Fidelities of the world, ICE, these type of firms, CME. And I think we're seeing, I can tell you that I'm on the ground. I mean, we're seeing migration to CME now. You're very strong FCMs, EDF Man, et cetera. These type of firms, these are real players. I mean, so I just think that migration will continue. And I guess by final, what irks me a little is that some people say, oh, wow, what wonderful innovators. There's so many people that can develop a matching engine and run an unregulated derivative exchange, but nobody will because it's illegal. So yeah. I want to sleep at night. It's just clear. I mean, it's U.S. derivative law. It's not just the U.S.
I tend to agree. So I want to kind of build up and talk a little bit about the product set here. And I think some of the derivative products that you're introducing here are probably unfamiliar to some of the listeners. So maybe we could do it this way is just, could you explain maybe what a derivative is using a non-crypto example? And then would love to get into the crypto context of who the natural long and who the natural short is and build it up from there.
I think the best way to, and just try to be timely too for the people listening to this podcast. So Mexico as a country, they're a very large oil producer. They hedge their production every year. So I think this is a famous commodity hedge. It's an incredibly well-known hedge. You've been doing it for over 20 years. And Mexico will come in and hedge. And so what they do is they'll lock in certain prices. And especially with this year, thankfully, they hedged much earlier in the year at great price, at very high levels. So they really escaped. So what they do is they're an oil producer. So what they'll do is buy puts. Basically, the most simple structure will just buy puts. And what a put does is basically it's almost buying insurance. So say we're trading $50 in WTI. If they buy the $40 put, they're basically hedged from $40. So when crude goes negative $45, they're going to be okay. They're going to be in a good position. And that's really a very famous hedge and a very simplistic, they use very sophisticated strategies now, but that is one of the most famous hedges in the commodity world. The other side would be an airline that might be exposed to the price of jet fuel. So what an airline will do is potentially buy calls on jet fuel because they're concerned about the rise in the price of jet fuel. And those are just two basic examples, and happy to elaborate, Matt, if you'd like me to.
That sets the ground really well because I think we can translate that over to the crypto front. So let's talk about miners. So put yourself in kind of the Bitcoin miner shoes. Let's say you're a large US-based industrial scale miner. What are you thinking about in terms of hedging your exposure here? And what are you trying to solve for?
So originally, the first product we rolled out was, we were talking to the miners, of course, about price. And a lot of miners, when we first started, the CME wasn't up and going. We were trying to trade OTC bilaterally, but a lot of the crypto funds in their funds are just starting out and they were small and they weren't that well capitalized. So it was challenging to get bilateral agreements in place because of the credit issues. So the first trade we did was about a year ago, and the timing, there is a seasonality, somewhat of a seasonality to hash. You have the onset of hydro season right about this time, May 1st or so in mainland. And so we do see a significant hash come on board online. What happened is a miner came to us and said, guys, can you structure a difficulty swap to hedge my exposure to difficulty? So he said, sure. We went to we have two quants who really worked on that, and we were able to develop a difficulty swap, and we were able to hedge the miner's exposure to difficulty. So he bought the swap. We had another very quantitative firm who was able to develop the model to hedge and agreed with our math, and then I think hedged out 3 or 4 periods. So we call difficulty periods D+1, +2, +3. Right now we're looking at, say, D+6. Somebody's trying to hedge D+6. So that was the first hedge we did. And then we started really diving in deep with the miners, just because it was just like an oil producer. The miners are the same thing to us. And we started working with a number of miners about talking about debt, equity. Debt is extremely expensive and really restricts the operational flexibility of the miners because the covenants, they're so restrictive. And then equity is incredibly dilutive. So we said, what about if you were to sell your hash rate forward, and we were able to get buyers? So I think the first contract we executed was about 4 or 5 months ago, and the first tenor was 120 days. So we did a beta test. One contract is 1 petahash. And we said, okay, let's start slowly here. Let's make sure we've got everything right, all the assumptions, and make sure, it's flowing through our prime broker, and then it's into the pools directly into the prime broker, and then flows into the individual's account. So everything was running smoothly, great. Okay, good. And then we did 5 contracts. And then the next thing we know, a miner, because there was a tremendous amount of positioning before the halving. And then we had 1 contract to 5 contracts. And then we had a miner said, guys, can I sell 100 contracts today? And we scrambled, and we were able to actually get the trade done in about 5 minutes. So there's real appetite on both sides of the book. We call it the book. We're sellers and buyers. So we were able to trade hundreds of contracts. And then we also had to do a secondary deal. And then there's so many derivatives that we can layer on top of that to really meet bespoke needs of the miner or the buyer. So there's callable hash swaps, there's puttable hash swaps, there's, you name it, we can structure it. But with risk management, we always like to say, keep it as simple as possible and no simpler. But we really advocate to try to keep it simple. But it's really great for the miner because they can lock in price and difficulty. I mean, there's also transaction fee swaps. We're looking at proof of stake and slashing swaps, et cetera. I mean, I think we're working on 3 dozen just different swaps. And really, it's just, like I said, it's just identifying the long, identifying the short, and can we structure something that can work for both parties? And it was a fascinating trade. And we collect so much data, and we're really proud of the fact that one of our miners, we saw that one of the pools was overcharging them. And we collect this data. We watch this data so closely that we notified this miner. And I think we're going to save them $1 million a year or something like that. And he gave us a little shout out on LinkedIn. So my team was really proud of that.
This is fascinating because I think people have this picture of what the mining industry is, and it's very far from where it originated, where you could, on an individual computer, mine, CPU, like how Satoshi was doing. And obviously we've graduated to GPUs, FPGAs, up to ASICs, and now these are really industrial scale. And I guess what you're offering, to radically oversimplify it, is just a way for those miners to get US dollars in a timely fashion and pay their operating expenses and to go out and buy new equipment and to really run their business like professionals. What's your sense of that kind of level of sophistication? I think people might be surprised at how sophisticated some of these folks actually are.
The folks that we're talking to are super sophisticated. I'm learning something new every day. I mean, one was one of the largest power traders in the commodity market. The folks we're talking to are super sophisticated, and they're great guys to deal with. I mean, we're really learning, they're learning, and it's scary how little I knew about mining when I first started. But some of them are backed by private equity. But no, the folks that we're dealing with, this is not your mom and pop operation. These guys are quite sophisticated and very familiar with hedging tools. Stepping back, I mean, high level, as you basically articulated very well, as a miner is looking to finance the growth of their facility, say they sell $1 million worth of hash, they take the $1 million and hopefully they have good access to the manufacturers, and they go buy, hopefully take delivery of gear immediately. They turn that gear on and then sell hash and then sell more and just bootstrap the whole growth of their facility. These are quite sophisticated operations. And there's also, we have the concept of collateral agents to mitigate credit risk. It's definitely a sophisticated trade. In our view, very similar to some of these very niche commodity markets. It just doesn't translate well to an exchange. But for someone like us, it can be nimble, and just whenever we do it, if it is a swap, we have the ability to just report it into a swap data repository. So we've got a lot of flexibility there.
Do you find that miners are naturally long Bitcoin in the sense that they would hold it on the balance sheet and only hedge some of their exposure? How do they position themselves? Is there a best practice there, or is it a case-by-case basis?
I'm over my skis to talk about Asia, but I can tell you in North America, they're much more mindful of stability cash flows and much more receptive to hedging solutions, where from what I understand, and this is purely from what I understand, so don't hold me to it, but from what I understand, maybe that the mainland miners are much more aggressive in their positioning. We don't have much coverage in Asia. We speak to a lot of miners in Asia, but we don't actually execute. This market we've developed and we've kind of perfected in North America. Now we're looking to roll out globally. But we really wanted to just get it right first before we started really rolling this out globally. But that's hash. And then we could always get miners on exchange and then just do simple strategies where a lot of traditional hedgers like to buy a put and sell a call and do it costless. So you do a costless caller, we call it. But that's if the miner wants to get on exchange. We do have some miners who are onboarding on the CME and ICE now. So we thought, what's the cheapest hedge, whether it's selling hash, whether it's on exchange, buying puts, selling call, just buying puts, want to keep their upside. It's whatever they want to do. But we really look at it holistically, whatever is the cheapest form of hedging.
That makes sense. I like the example that you gave at the outset of the Mexican hedge and the airline being on the other side. Talk a little bit maybe about who's the other side of that trade from the miner, kind of who is looking to take on that exposure.
Definitely sophisticated funds in crypto. They understand the trade. We pitch it to them, 2 minutes, they get it, they're in. It's definitely some of the funds. We hope to roll out to more and more funds. It's family offices, it's high net worth individuals. We actually, we traded 100 petahash, and we actually, from our former life in commodity markets, we explained to some commodity traders, hey guys, do you want to buy an asset? The miner will sell it at a discount to get the cash up front. So if you want to buy an asset at 10% discount on spot, this contango in the curve, you can basically lock in. When I say contango, that means the future is trading above spot. And so we had two family offices who had never traded Bitcoin. They had a limited understanding of what Bitcoin is or what it is. And they said, well, wait a minute, but these are super sophisticated traders. So what they did is they just bought the hash from us and then just hedged it using their futures. So it's really interesting, like how hopefully the Bitcoin, as we grow in this trade, hopefully introduces new capital and et cetera to the network. That I think that's super cool that two people who never traded Bitcoin before actually bought hash and hedged in the futures market. So then you really get, what we think is super cool at BitOoda is you really get an understanding of both the physical and financial side of the trade. So I think that's super important.
That's really interesting. I guess one variable here that's interesting to think about and curious how you think about the risk exposure is just that hash rate. So what would happen if 10% of the network were to drop off? And I'm obviously kind of thinking about what's going to happen here around the halving. Or conversely, what would happen if 10% more gets added on a daily basis? So how do you think about that? Just that, I guess that's a reality of this asset class. How do you think about pricing and how do you think about just how these markets function with that uncertainty? Or is it uncertainty, I guess?
It's definitely, so the buyer will take that uncertainty with the margin. So he's taking on price and difficulty risk, or he or she is taking on price and difficulty risk. And this was this is in COVID-19 and just how that impacted this trade. It was really enlightening. So the buyers, of course, there was concern about performance of the contract, making sure we were airtight and if there's any force majeure, et cetera. We're very mindful of that. That's all in the contract. But what happened is the buyers, so hash, as you probably know, it fell off. It got crushed by something, I don't know, roughly 20% at one point. So the prices, before we dumped down on March 12th, the buyers actually, you were just mining a lot, you're able to mine a lot more Bitcoin than they anticipated. And then however they managed to trade, they sold the lows, of course, but if they managed to trade accordingly, a lot of the buyers have a structural long view to Bitcoin. So they're not going to be forced to sell. But it was really interesting how hard that hash came off the network. It was really interesting. And then I think the miners were fine too, letting it go where they did and seeing Bitcoin go all the way down to 4,000 or whatever level it did. So it's kind of a win-win for both people, depending on how they manage the risk.
That makes sense. So maybe just stepping back and talking about crypto market infrastructure here, you're obviously well-versed in the derivatives and the spot market. So maybe talk a little bit about the relationship between those two markets. Why did you choose to focus on derivatives as opposed to spot? And how do you see these two markets coexisting?
Spot, to me, you have these massive high-frequency firms that, for me to try to even compete with these, some of these firms have spent billions of dollars on infrastructure, billions. The level of sophistication is incredible. I saw this in my experience at ICE. Some of those sophisticated high-frequency firms in the world are trading crypto. There's just no way I could ever compete, nor is that my expertise. Where myself and my team's expertise is in nonlinear products. And really, spot to us it's so competitive. It's so challenging to defend that market, to make it. It's basically cross market all day long. Granted, that's when we're quiet, and then when things starts widening out, when there's some volatility. But really, we're a non-linear firm. That's our DNA. We don't know the spot market. We're not good at it. But as we look to transition from an agency firm into a principal trading operation, I mean, that's really where our focus is, in non-linear products. And we do this correctly. We shouldn't have any exposure to really the price of Bitcoin, because we'll be trading swaps, options, etc. We're not going to take the right bet on Bitcoin. We have no edge in that. There's a lot smarter people in this space than us who can make calls on Bitcoin, etc. So that's not where our expertise. Our expertise is really regulated firm, customer focused, and serving our clients and providing liquidity for non-linear products.
That's great to hear you say, and I couldn't agree more just around the maturity of that spot market, and it's come such a long way just in the time that I've been in the space. So maybe talk a little bit about where we are in terms of industry maturity. You mentioned Paul Tudor Jones coming into this market a few days ago, which I thought was huge. Where do you think we are in terms of bigger financial institutions entering? Is this infrastructure there yet such that they can enter in size and would feel comfortable? And curious your perspective on what needs to happen in order for more capital to flow into the industry.
I think this is probably the biggest news in crypto. I mean, to have Tudor basically validated and just such a well-respected person, trader, fund manager. I mean, to have him validate the asset class is, I really think, some of the biggest news in the history of Bitcoin. And I think that you've got Rentec or Renaissance. I don't ever make predictions on price, but I think you're finally going to see real institutional players come in here. And people have to realize, like when my old days in crude and commodity derivatives, when a fund has a view, they're going to take, say, 50 basis points of that fund or whatever, depending on liquidity, and maybe not for Bitcoin right now, but they're going to express that view. They're not going to be buying 1,000 Bitcoin from an OTC market maker. They're going to be in the CME futures market or option market, and they're going to be looking to buy massive size. I mean, to move the needle of a $10 billion fund, you have to have real exposure. And I mean, sometimes we would put on trades that would be 50 basis points. We would buy 50 basis points of crude premium, call options or whatever it was, whatever idea the fund wanted to express. But we're talking about massive amounts. The trading side is going to grow exponentially. So that's what we see. We think it's here. We're in conversations with a number of firms. We never thought that we would be at this stage speaking to the institutions that we're speaking to. And I could say some of those sophisticated global institutions that are looking either to make outright plays on getting some exposure, having some exposure to Bitcoin, or to really invest. Everyone's trying to we've seen a lot of institutions trying to really play the infrastructure angle. And these are some of the largest global financial institutions in the world. And so it's here. I mean, I don't know. I think we're really going to start seeing, I think we've gotten through the halving, great. Now let's get through the COVID. And then I think what we're hoping is that Bitcoin decouples from equities. We still think it's correlated to equities, and we'd like to see that decouple. And I think then the story really emerges. I think Paul Tudor Jones said it best. And that's kind of our view about what the Fed has done here. I mean, we should see Bitcoin.
I agree. I think we're kind of getting to the point where it's irresponsible and it's not okay to have an opinion on this asset class, which at minimum doesn't need to necessarily be a positive opinion, but having an uninformed opinion is not okay. I kind of put myself back into some of these rooms that capital markets participants were in 2015 and early 16 around private blockchains. And kind of the popular narrative there was everyone wanted to do a blockchain project, but no one wanted to hear anything about Bitcoin or public blockchain crypto assets. Not only was it an ignorant kind of self-serving move at that point, people just wanted to be seen as doing a proof of concept and they didn't want to hear anything about public blockchain assets, but it's financially irresponsible at this point to have that type of an opinion when you have respected allocators that are taking this seriously, when you see what's actually going on in the world with this money printing and some of the implications that we're going to have there. So it's really exciting for me to see. I think we're kind of at the point where we're still incredibly small as an industry. I think if you look at the balance sheet of Apple, current assets are still larger than the total market cap of Bitcoin, but it's getting too big to ignore at this point. And I think we're still in the early innings.
And Matt, you've been in the space a lot longer than I have. So, I mean, yeah, I completely agree. You cannot ignore it. And you just really, if you're an asset manager, you don't have any allocation to Bitcoin, I think it's foolish. And I'm a spread trader by heart. I mean, really, I've always been a spread trader. So we look at Bitcoin to gold. I just put out a piece last week that tried to make it a catchy title, but I said Bitcoin is bold, gold is old and cold. I mean, I really see that spread. We call it the do spread, digital versus old economy spread, but we watch that spread pretty closely, and we really see if you're going to look to hedge with Bitcoin or gold. I mean, I don't know how you can make a case to buy gold over Bitcoin if you're looking for that inflationary hedge, et cetera. I mean, it just makes so much sense to us. You also have this huge optionality, this tech optionality you own for free, basically, that I think the trade could be explosive, but I got to be very careful on price projection with regulators, but I'm very constructive on Bitcoin, especially vertical.
Yeah. So I guess my closing question before we wrap it up is just, what are you the most excited about over the next few years here? What parts of the industry, obviously the one that you're in, you're pretty psyched about, or else you wouldn't be doing it, but what excites you the most right now?
I've never been so engaged in my entire career. I think some of these trades are just the coolest trades I've ever put up, and just work with great people and just keep trying to build this ecosystem, and really excited to see the institutional adoption happen pretty quickly. But I mean, I came out of retirement to do this. I had no idea what I was going to get doing. I just can't wait to get up to work. I don't know who the lunatic was that made this a 24/7 market. I mean, they could have been 24/5. I mean, I'm just saying, but it just doesn't stop. But I'm just super excited to really see where this goes and really just keep learning. I mean, I'm intellectually restless by nature. I'm really excited to learn about all these other super exciting projects. And I hope that all these incredible entrepreneurs, the project founders who are putting it on the line, like all of us, have success and are rewarded for their efforts. I can't wait to see some of the innovation. I mean, just the people we've met and come across, and I'm really excited for them hopefully to get the capital they need to really build. And it's not just Bitcoin. Believe me, I'm not just all by any means. It's just something that's what I'm focused on right now, but I really want to learn. I really would like to learn a lot more. So yeah, stay tuned for my DeFi report, but stay with me. It's going to probably take me a couple months.
Nice. Well said. So Tim, where can people learn more about BitOoda? Where can they follow you? Where do you want to send people?
We have a website, info@BitOoda.io. I think that if anybody wants to reach out to us, and we don't put too much on Twitter. We're pretty private. We're shy. So we're not too publicly, but we do put in some research on Medium. If anybody wants to get on our research, we put out 3 or 4 pieces a week. But I guess info@BitOoda.io is probably the best place to start.
That's great. Well, Tim, this is super exciting. Really going to be interesting to see where this derivatives market unfolds. You're certainly at the bleeding edge here. So thanks so much for sharing some of your stories on the podcast today.
Matt, thanks so much for having me. Really appreciate it. I love the work that you and Nick are doing.
Thanks for listening to another episode of On the Brink with Castle Island. To find out more about Castle Island, visit castleisland.vc. To listen to all of our podcast episodes, please go to onthebrink-podcast.com or just click on the tab in our website. Thanks for listening.